Financial planning is a lot of fun. It not only provides you clarity, confidence, and assurance, but it gives you clear direction as to where you're at right now, where you want to be, and specific steps that you can take advantage of right now to get you closer to your goals. I'm going to share with you an example of a financial plan, what working with a real financial advisor looks like, and you'll start to get some clarity maybe for your own situation and maybe whether or not it makes sense to work with a real financial advisor. So here we have the Trout family. I mean, you knew it was going to be fishing related. We've got Mr. Brown, Mrs. Rainbow, and they've got two kids, Grayling and Cutthroat. Now, the two kids, sometimes we'll include them in a financial plan, sometimes we won't. These two children are independent, they're out on their own, 30 and 35, they have their own families. But from an inheritance standpoint, it's important to include them if at some point in the future they're going to inherit assets, or maybe grandma and grandpa are going to gift assets through them to their grandkids, whatever the case may be. So we've got the brown trout and the rainbow trout here, husband and wife. They are 60 years old. We're planning for them to live till 90. Now, this is a big assumption and just one of a few that we'll review today and over the course of future episodes. But for most people, we like to be conservative and err on the side of not running out of money. I mean, if they pass away before 90 and we've built a successful plan from a financial perspective, wonderful. We're in good shape. But if we haven't planned long enough, and they spend their assets for longer than expected. Maybe they need a nursing home or assisted care facility longer than they originally anticipated. Well, that can put some pressure, stress, and anxiety on not only you, but also on the plan. Now, this couple, they live in California right now, but they're thinking at some point they may want to move closer to their kids in Arizona or in Texas. And that presents just kind of right off the bat a tax planning conversation. Because if they're going to live in California the rest of their life and take income, whether it be from a pension, IRA, or 401k, that's going to be taxable as ordinary income, both at the federal and at the state level as well. Whereas if they move to Arizona, the state income tax drops significantly. And certainly if they move to a state like Texas or Florida, among others, then there's no state income tax. Of course, there's property tax and other forms of tax that may apply, but it's an important conversation. And you'll find that as we go throughout this scenario, it's not just talking about investments. And it's not just should we be putting money into a pre tax 401k or into a Roth, but it's quite a bit deeper. So after we've got the family section filled out, I like to go to income. In this situation, Brown makes 200,000, Rainbow makes 70,000, and then we'll put in the numbers for Social Security. Now, ideally, we'll have this individual go to ssa.gov. You take 10 or 15 minutes and you'll get a statement. They used to send them to you in the mail, if you remember, but nowadays you really got to log in to be able to see that in real time. We'll just use an estimate for them based on their income, but we'd like to see that there. Now, we can project a lot of different numbers, and at the end of the day, the way that this software works, it's called Right Capital, by the way, is it's cash flow based. So we're putting in a series of cash flows, projecting those in the future, and seeing what they produce as income in retirement, or seeing what needs they require for you to live the life you want to live. In this situation, we're planning on them getting a 3% raise or increase to their income from now for as long as they work. And that's the same thing for Rainbow. In fact, maybe for Rainbow, she doesn't get quite as often a raise, so we'll make hers 2% in this situation. They don't have any other sources of income. It's just kind of the regular W-2 income. If they had a bonus, we could certainly add that in. Maybe if they had some self-employment income, we'd put that in as well. Neither of them have a pension. They just weren't eligible for that, but certainly that would be included. And there's a lot of other things we might include depending on the situation, but we'll keep it simple for you today. The next place I like to go is savings. Now, brown trout and rainbow trout, they're serious about saving for retirement. At 60, they want to be able to put in as much as they can and do the catch-up contributions. So for them, they're maxing the 401k out. And for Rainbow, she's a teacher, so she's using a 403b with her employer. For Brown, he's putting the maximum amount in. He gets an employer match up to 3%. Yippee, it's not a ton of money, but hey, 3% of a salary on 200,000, that's a little bit of cash. And it's pretty straightforward for him. If we go to Rainbow, the match, maybe it's a little bit different. Maybe it's 50% up to the first 8%. So she's got to be putting in 8% and they'll match it up to a total of 4% in this situation. But hey, she's already maxing it out. So it really doesn't make a difference to her either. They're not saving in any other place until they chat with me and they realize that they're on a qualifying high deductible health insurance plan right now. And so then I come in and tell them, hey, you're eligible for an HSA. And they respond, well, our employer doesn't offer one. I say, hey, that's just fine. You can open one up on your own. As long as you have a qualifying high deductible health insurance plan, great. Let's crack open an HSA and you can make contributions to it. Once I talk them into all the benefits of the HSA, which we're not going to dive into right now, but essentially just that the money goes in pre-tax, it grows tax-free, and then down the road in retirement, which isn't too far off for them, it can come out tax-free if it's used for qualifying medical expenses or to pay for COBRA premiums if they stay on their employer's health insurance, which they won't in this situation because COBRA is nothing to write home about, but they'll go on to Obamacare or the Affordable Care Act to shop for health insurance. And while they can't use HSA dollars to pay for that, they can use them to pay for Medicare premiums when they turn 65. So we have them maxing out the HSA there. They're not doing IRAs yet, but this is where they stand right now. Their living expenses are $7,000. Now, this doesn't include a mortgage because their mortgage is paid off and they own their home outright. So we'll take you to that section here. You can see we put in the value of their home. It's currently valued at $750,000. They bought it a number of years ago for $250,000. Now they're thinking about selling this home in California, right, and moving to be closer to the kids and grandkids. In this situation, because they've lived in the home for 2 out of the last 5 years, they can actually exclude up to $500,000 of gain in the value of their home, of their primary residence. So if they were, in fact, to sell the home today and move closer to their kids, well, now that $500,000 of gain is not subject to federal income tax, which is nice. Now, we're not sure if they're going to do that or not. So we're not going to model in them selling their home right now, but we'll just keep that in the back of our mind there. We're growing the value of that home at 3% a year. Property tax, $4,000. In fact, in California, I know it's a little bit more than that. So we're going to make it closer to $7,000. And insurance, I don't have to tell you, we're going to call it $3,000 in California. Tax increase 3%. Maintenance on their home is about $4,000. It's not a really old home, but it's got a few years under it. So we'll save that right there. Home's paid off. They've got $80,000 cash in the bank. Now, it's not just all sitting around in a savings account. They have some in some CDs. And I explained to them the value of either using a money market fund or a high yield savings account so they can earn a little bit of interest instead of the pennies that they're getting from their current bank or credit union. Well, now they can earn in today's market and interest rate environment somewhere around 4%, which is pretty nice, especially considering they want to keep this really liquid and for an emergency fund. What I found is that the older you get, the more conservative you want to be with cash on hand. And I think $80,000 for their standard of living is just fine for them. Rule of thumb kind of says between 3 to 6 months of living expenses. So if we take the $7,000 a month of expenses and we say times 3, you're sitting around 21,000. But because of their age, we like to have a little bit extra just to sleep at night. Here's where they stand from an investment and retirement savings standpoint. Brown's got $1 million in his 401k. It's all pre-tax. Rainbow, $500,000 in her 403b. They have an IRA from before. They had a previous job and I think actually was a pension, and they did a lump sum rollover to an IRA and invested it so they could be in control. That's about 500,000. And then they also have a brokerage account of 200,000. That's a combination of two things. One is Brown at a previous job had some equity from a previous employer, some stock options, and he turned those into stock and has just kind of been holding them for years and years. And the other portion is an inheritance they received. Rainbow's mom passed away, had a home, split the proceeds of the home amongst the kids, and that cash has been put into a brokerage account. It's been invested, but their investments are kind of all over the place. They don't really have a strong strategy that's unified across all the accounts. It's kind of a little here and a little there. So altogether, on the investment side, $2.2 million is what they've got. So we're looking at, again, cash in the bank, their investments, no debt, property's worth $750,000. They are looking at just over $3 million of net worth. Now, for most people, the value of your home, it really doesn't make a difference unless you're planning on selling the home and downsizing to a smaller dollar valued home, in which case now you'd have liquidity, you have some extra cash to live on. But I'll tell you right now, that's far and few between. It's pretty rare that that would happen. And so what we're really looking at is cash in the bank and their investments to provide the income, the cash flow that they need to live on in retirement. The last section in terms of data input is their goals. Now, for them, they want to retire in 3 years. Remember, they're 60 years old right now. And let's face it, most couples, if they're both working, they want to retire around the same time. It's pretty rare, in my experience, in working with a number of families all across the country, many of whom are in their 50s and early 60s, that if one of them retires and the other one's still working, it's pretty rare that they'll continue working much more than a year or two, because you want to go on the cruises and you want to go on the trips while you're healthy and you have that energy. So I'm all about it. So we're going to plan on both of them retiring around the same time. This brings us to a point where we want to talk about health insurance planning, because for them, they're going to have this 2-year window between when they retire at 63 and when they go on to Medicare at 65. And we just want to be sure we're thoughtful about how much income they're recognizing for tax purposes, because it has a direct impact over the amount that they pay for health insurance under the Affordable Care Act. And it also impacts Medicare, because Affordable Care Act looks at your income in the current year you're on that health insurance plan, whereas Medicare has a 2-year look back window. So if they do a bunch of distributions from a 401k or IRA in the year they retire at 63, they will feel the pinch of that when they pay their Medicare premiums at 65. Now, it recalculates every year, but I just want you to know there's a 2-year time delay. And so it's really important that we're doing some good, comprehensive financial planning for them, because it's not just about the investment and taxes. There's so much more to retirement planning that can matter to them. For most retirees, they spend roughly the same amount of money when they retire as they did when they were working. Now, sometimes we'll see a little spike in the first few years of a recent retiree because they're going on more trips and traveling or doing hobbies, whatever it is. So, but it typically doesn't last very long. We'll say that much. So typically you have kind of the same standard of living you did in those last few years you were working. They have a joint vacation goal of $8,000 annually that they're spending. And so we've added that on top of the kind of day-to-day $7,000 a month. And by the way, these expenses are all growing in the background with inflation. For them, we've modeled inflation at 3.5% from year to year. That's pretty conservative. Well, if you look at the last few years, maybe not necessarily, but over a long period of time, inflation kind of ranges between maybe 2.5% and 3%, depending on the period of time you're looking at. We want to be a little more conservative, and so we made it 3.5% for them. And so just recognize that in the background, it's the same standard of living, but we're going to need more cash as the years go on. And so it'd be unwise for them to have a large chunk of their portfolio locked up in fixed income or in bonds that don't appreciate. We want to have a little bit of stock in the mix or other assets to keep pace with inflation. They donate to charity on a regular basis and they plan to throughout the remainder of their life. So we've planned for them to give 10%. In fact, they tie it to their church on a regular basis. There's some charitable giving strategies that can really matter here, whether we're doing a donor advised fund for them, maybe a charitable remainder trust, unlikely in this situation, but maybe a more complicated one, or maybe just donating appreciated assets in kind. Let me just give you a quick example of that. Remember when we talked about their brokerage account representing $200,000, and there were some assets, particularly the equity that Brown had received from the previous job, that had appreciated quite a bit. And if Brown were to sell them, he'd be on the hook for a big tax liability in the year that he sold them. That's really the reason why he has not sold that stock, is he didn't want to face the ginormous tax liability that would be associated with it. However, Brown and Rainbow have been donating cash to the church. And if instead they donated that stock, the highly appreciated stuff, to the church, which is a qualifying 501c3, a tax exempt organization, then not only could they avoid the recognition of gain in that highly appreciated position, but they could also deduct the fair market value on the day that they gave that stock to the charity or to the church. And if we did that strategically and itemized on their taxes in that year, that could have an enormous tax saving event for them. And that is just what we're going to do for them. In fact, we're going to donate a decent chunk of that stock to a donor advised fund, a combination of both donating highly appreciated assets and doing it a few years in advance. So instead of them just giving 10% of their income every year, we actually front loaded the next 5 years of contributions that they're planning on giving to their church. We did it all in 1 year to maximize the tax deduction. And then in the consecutive 5 years, each year they can give out the required amount from the donor advised fund. It's such an incredible tax planning opportunity, has enormous savings for them, and the cash that they would have otherwise used to give to the church, they can go and buy other positions in the brokerage account, which effectively steps up their tax basis and diversifies them at the same time. Because remember, a big chunk of that brokerage account was all in one company stock. And now we want to diversify the risk, especially as they prepare for retirement. Back to the goal section. Annual healthcare and retirement costs. There's a few ways we can do this, but for them, we're going to say that it's a detailed estimate. So we're going to say, hey, pre-Medicare for them, it's going to cost them about $6,400 each for the year. And then once they turn 65, it'll be an estimate based on their adjusted gross income. Long-term care costs. I just want to spend a minute on this one. Boy, this is one area that has seen enormous inflation. You look back at the last 2 decades or so, and on average, costs associated with healthcare and especially long-term care, which includes things like nursing home, assisted living, or in-home care, has risen at roughly 5% year over year. And so for these expenses, we're increasing the cost 5%, whereas everything else we're increasing at 3.5% for just kind of general living. Now, typically, in many situations, one spouse will outlive the other and kind of take care of them, but the last spouse around, maybe they need some assisted living or some in-home care. So for Brown, we normally will just do it for the younger spouse or whatever. In this case, they're the same age. So we just said for Rainbow, the last 2 years of the plan, she's going to have in-home care, which on average, based on last year's numbers, is roughly $75,000. If we wanted to add any other goals, like maybe they want to get a new car every few years, or they want to gift some money to the kids, we certainly could add that in here. But again, we're going to try and keep this as simple as possible. So now that we're at this point, we can open up one of my favorite tabs, which is the retirement planning section. There's a lot that goes in here, but we're going to start off by looking at the cash flows because remember, this is really what's driving the financial plan in this situation. You can see we're planning for the next full year. So for 2026, if we wanted to plan for 2025, we certainly could. But for 2026, we're showing their combined incomes at 270,000 as a household. Here you can see their living expenses, $84,000 a year. We have some living expenses connected with housing, property tax, insurance, and maintenance. Remember, their home's paid off, which is huge for them. If it wasn't, we'd see the principal and interest associated with their mortgage here as well. Here's the goal section. You can see the $8,000 a year for the vacation, and then their charitable giving, $20,000 is what they're doing there. Taxes broken down between federal, state, and FICA tax. Remember, FICA, that's Social Security and Medicare tax. This one will go away when they retire, but because they're still working, you can see that's a big chunk of money. Here's their planned saving. They're both maxing out their 401k. It's about $70,000 they're putting in, maxing out the health savings account. And then we have some excess cash flow, about $7,000. Now, in this situation, for this level of income, I would call $7,000 a rounding error. If they were making 70 grand, I wouldn't. But because they're making 270,000, maybe these are just unconnected expenses. Maybe their bank account is in fact growing by 7,000. Whatever the case may be, we're going to assume that the 7,000 is just going to be saved at the end of the year in their bank account because they're confident on their expense numbers. And that's something you want to be confident on as well. If you're unsure, hey, let's raise this up and let's make sure that we're strong here because if we're kind of wishy-washy on how much it costs you to live right now, then we can't be as confident in your financial plan at the end of this. Assuming we're all good here, we may decide to drill down a little bit deeper where we can actually look at some of the cash flows, the distributions, what that's looking at. But for now, we'll keep it as is. One other section that's insightful as well is the account values. We haven't dove into this too deep, but we can plug in the different investments that you have and we'll build in some assumed rates of return to make sure that we're confident. For them, we're projecting about a 6 to 7% return on their investments. They're not ultra aggressive, they're not ultra conservative. They're kind of right in the middle for their age and where they're at. At the end of the day, there's a few things that can improve the success of your financial plan. There's kind of 5 big ones. One is you can die sooner. The second is you can invest more aggressively. Now, that's one I hesitate to bring up, but that would be an option. The third is you spend less. Fourth, you save more. And 5 is kind of it's kind of a combination of the others, right? Reduce your living expenses, save more, invest more aggressively. There's a lot of things that at the end of the day kind of help in combination or in concert with each other. But just know that in this situation, we're testing a lot of different scenarios. What happens if markets are up or markets are down right when they retire? What happens if they live longer than expected or inflation is higher? What happens if Social Security doesn't pan out like it's expected to? And I don't have to tell you, by 2034 or 2035, most experts agree that there's going to be some significant changes to Social Security if the government doesn't do anything in the meantime. And you can expect roughly to receive 80% of your payment by that year if you're on Social Security. But don't hold your breath. They'll probably make changes before that happens. But my guess is probably at the final hour. In this situation, of all the different scenarios we've run, 69, let's just call it 70% of them are favorable. Now, where do we want this to be? I like to see it above 85%. If we can get them above 85%, then I can feel confident that in their situation, based on the plan we've built together, they'll be able to achieve their goals and have their retirement they'd hoped. So let's show some changes that they can make to get them a little bit closer to retirement. Oh, the last one, excuse me, the fifth option I mentioned earlier is they can work longer, right? Increasing their income or working for a prolonged period of time, that will help as well. Kind of goes in connection with spend less, save more. So right now they're retiring at 63. What happens if they work one more year? So they both work until 64. Let's refresh that. On the right hand side, that's going to stay constant. That's the current plan. On the left hand side is the proposed plan. So assuming they both work one more year, hey, that's a meaningful difference. They're able to get to 76% probability of success. Maybe they can reduce their monthly living expenses. Maybe it's not $7,000. Maybe in fact it's 6,700. So we can knock it down 300 bucks both now and in retirement. Let's see what that looks like for them. Okay, you can see just a few $100s a month over a long period of time. I mean, we're talking from 64 until 90. That makes an incredible difference. Maybe they choose to invest just a little bit more aggressively. Instead of investing in 60% stock and 40% bonds, maybe we do something like 65-35 or 70-30, at least for a few more years while they're still working. That might be an option we take care of. Maybe we just want to keep it simple and we decide, hey, you're going to both work till 65. We're going to keep living expenses down at $6,700. 85% we're there. And if we want to be even more confident, we certainly can do that as well. Confidence is all based on the data that we put in, but you can see this is a projection for their assets over time. And it gives you a range, right? The further out in the future, the more unknowns there are. But at the age of 70, you can see that of all the scenarios we've run for them, the median puts them at $3.9 million. And for most people, reality is in that dark blue shaded region. So, of all the scenarios, both favorable and unfavorable, they're sitting somewhere between 2.8 million if we look at the 25% mark to 5.4 million. All right, so it gives us kind of an idea. Whenever we see this dip down below on the x-axis, that's showing us this greater risk of them running out of money and just living on fixed income, right? Which for them would be Social Security. It's a relatively small risk given the financial plan that we've modeled, but one nonetheless that we want to be aware of. You can see here that their savings rate, 36.5%. That's great in this situation. Something that would help improve that is if they both make contributions to an IRA. Now, one of them can, and one of them is probably unwise for them to do that because at their income level, they don't get a tax deduction for making contributions to an IRA, and they are not eligible to make Roth IRA contributions either. But for Rainbow Trout, because she doesn't have money in an IRA, she can do something called a backdoor Roth. And in her situation, she can plug in $8,000 into a Roth IRA. I think that's advantageous for a number of reasons, even given their high income. But the biggest one boils down to tax diversification. While they're relatively diversified from an investment standpoint, pretty much all their eggs are in one basket from a tax perspective when we look at their overall investments, because we're really just sitting on 2 million of tax deferred assets, 280,000 of taxable assets. This includes the cash, but they're missing out on the tax free. We're going to model Roth conversions in another episode for them, and you'll see that they're wonderful candidates to consider Roth conversions for at least a few years when they retire. My name is Rizek. I'm a financial advisor, CPA, and certified financial planner. If you've enjoyed this, ladies and gentlemen, let me introduce you to my new book, Finance on the Fly: Simple Strategies to Build Lasting Wealth. I think you'll find it an insightful guide that will dive deeper into these important retirement planning concepts and strategies. You'll want to stay tuned for future episodes just like this.